Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined by my good friend Cameron May out there in the chat, also an education coach and a great educator. He's going to be there to help answer your questions. He's a 20-plus year veteran of the financial markets. He's been teaching this stuff for a long time, so we're glad to have him here. Most of all, we're glad to have you here out there in the chat with us, whether you're in the live version or the recorded version. Thank you for being here. We're going to talk a little bit about some neutral movement today. Volatility is relatively low. Markets aren't really moving around a lot, at least not at the moment. And we're going to see how we might take advantage of that circumstance in our discussions today. We're also going to take a look at our 14 DTE, 7 DTE strategy and see how that plays itself out in its current iteration. And again, remember, these are all illustrative and educational examples. But I'm just going to say this. Thanks for everyone being here. Remember to participate in the conversation. Chat in. Ask questions, discuss. If you're in the recorded version, leave a comment in the comment section. That helps you out. It helps us out as well. A couple of quick housekeeping items as we get started today. Remember that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy. Remember that investing involves risk, including the loss of principal, past performance, no guarantee of future results. Equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy, including those in index options. Now, remember that multiple leg option strategies, like the ones we're going to talk about in this discussion today, will incur multiple transaction costs. And remember that spread trading in most cases must be done in a margin account. Now, the index options that we're going to talk about, by and large, are European style options, which means that they cannot be exercised until expiration. However, American style options allow for exercise at any time during their lifespan. So anytime you're short an American style option, there's the potential that you could be assigned early on that option. May be more or less probable depending on certain circumstances, so be aware of that. Also, remember, we're going to be using the Thinkorswim desktop software platform, specifically the paper money version of that platform. Great learning environment, not a guarantee of future success, but it doesn't do certain things like facilitating early assignment of short options prior to expiration. Now, with the index options that are European style, we don't have to worry about that, but that is something that we'll want to pay attention to as you move your practice from paper trading to live trading. One other thing to think about is that things like liquidity, things like the time to go until expiration, all of those matter and have their own circumstances that you need to pay attention to. We'll call those out and point those out as we get into the discussion along the way. If there are specific circumstances that you need to be aware of. But it goes back to the idea of understanding the characteristics and risks of standardized options before considering any option strategy. So properly warned, DB, says I, is the phrase that I like to use after talking about this. A couple of things, though. We're going to talk about index options. We're going to discuss a couple of different strategies. We're going to look at some examples on the Thinkorswim platform. So let's go over there right now and take a look at what's going on. As I do this is a good opportunity for me to remind you to click on the subscribe button. It's a no-cost subscription. It helps you out, brings this content to you. It helps other people out because it pops it up in the algorithm. If you like what you see, click on that like button as well. That's going to help to bring this content to others as well as make it more accessible for you. And if you want to follow us on X, in social media, you can follow us at Ben Watson CS. You can follow Cameron at Cameron May CS. And I'm going to show you some additional resources as we get to the end of the discussion today. So thank you for being here as we get into this particular discussion. So Carol asks an interesting question, which kind of sets up this idea. Why are the TNX and the VIX spiking so much? And all the indexes are red. Did we get some sort of news earlier this morning? And I would argue that this is perhaps even in this particular case, the lack of news, right? The fact that we have market movement. This is the SPX and it's rallied up and we saw this gap up and this move yesterday And now we see kind of this run into a resistance level. We're kind of in this area, in this case at the 59.30 on the SPX. And we get this candle that, I mean, when you put it all into perspective, this is a small candle relative to other candles that we've seen, right? There's not a lot of movement going on, even though we've seen a bit of a push to the upside and then maybe a little bit of a push to the downside. At the end of the day, there's really not much moving this market. And I think, Scott, you probably have a pretty good handle here in terms of that assessment, right? What's going on? Maybe waiting for NVIDIA, waiting for CRM. You've got a couple of others that are coming with earnings announcements today. From that perspective, that is creating a bit of a wait and see mode. You can see that the RSI here on the SPX is just kind of sitting sideways. Would you argue that this is a higher low? Yeah, I think so. I mean, we won't know that until after the fact, right? But we get that move to the upside. Right now, in terms of things like the TNX, the interest rate, as MBU says, is interest rates were moving to the downside after the Fed discussion. Now moving back up a little bit as we see some, maybe bond selling going on those prices going up a little bit, selling into that. And so rates are rising a little bit. But we take a look at the NASDAQ, and this is where, again, that NVIDIA earnings may come home to roost. And that's about as doji a candle, about as equilibrium a candle as you can get at a resistance level in terms of that move, right? And we take a look now at the Russell 2000 kind of sitting underneath that range, RSI pulling back a little bit. And Carol, I didn't mean to characterize it as overreaction. I'm just saying, in terms of what's going on, we have a VIX that's kind of sitting at standstill at this particular point. We have indexes that are moving in a very small range. So there's a little bit of neutral movement here. And neutral movement oftentimes presents opportunities, right? As does volatility. I would argue, I've said volatility equals opportunity, as does the lack of volatility sometimes equals opportunity. We'll see how that works here in just a moment. But what I want to do in terms of taking a look at these particular ideas, we'll come back to our index grid here for just a second. And I want to answer Mike's question here, which is an interesting question. So what would I say is the biggest difference between trading index options versus trading other instruments? Well, first of all, it's in the construction, right? So let's kind of back up a half step here. An index in and of itself is just, so the SPX or the NDX or the RUT, those are just simply accounting for the value of the components of the index, right? In whatever construction, whether it's cap weighted, whether it's market weighted, whether it's performance weighted, whatever the index might be, right? Whatever methodology or algorithm they use to calculate the index, that is the calculation. So there's no physical underlying instrument here in the SPX. There is cash. So this is what's referred to as a cash settled index. And so in a cash settled index, those options, if we go to the trade tab here in this particular case, for, say, for instance, the SPX or the XSP, which we were looking at there as well, each one of these options settles to cash instead of underlying shares of the index. So it settles to cash to the tune of, in terms of notional value, 100 times the whatever that index value is, right? So this is a fairly hefty index, right, in terms of whatever that instrument might be. So that becomes a challenge, and that becomes kind of the reason why, in a lot of ways, index options become a popular product, because there's a known quantity that they settle to. There's a kind of an approach to trading index options that takes into account the fact that they settle to cash as opposed to underlying shares, which can move around. Once that's settled, it's settled, instead of taking on that additional risk. Now, obviously, you could argue, well, there's dollar risk. If you settle an index option to cash, and then the value of the dollar moves, well, that impacts the value of that settlement. Not necessarily so much as, say, for instance, exercising an equity option, taking delivery of the shares and having those shares go down overnight or for a weekend, and now the value of whatever you settled that option to has gone down significantly. So that's one of the things, right? The second is the second is that many of these index options are European style. And because they are European style options, they don't allow for early assignment. So an option holder, somebody that buys a long option, let's say we were to come in here and we were to buy a call option on the SPX, we were to buy this 5,900 strike call option, and we click through on confirm and send, and we see that we can see what that call option represents. What that means is we can't choose to exercise this option and turn it into cash prior to expiration, right? And so that becomes a feature, not a bug, if you want to think about it from that standpoint, because that means if we're short this option, if in fact we simply sold this option, there's still the risk, right? And the risk is for cash. I mean, this index could go up, infinitely, but the thing is, we can't be assigned early. So we have a definitive time in which we can manage this trade without that risk or challenge or fear, in some people's cases, of being assigned early. So I'm glad that we kind of went off down this road a little bit, right? And from that standpoint, there are other benefits or other circumstances that are unique to trading index options, things like tax treatment and things like that, that may provide additional benefits. Remember, we're not tax advisors. We don't even play them on TV. But we've got some great resources. You can get in touch with our branch representatives. Your financial consultants at the Schwab branches can help to direct you to some of those resources that can talk about some of those circumstances. But it's something to kind of keep in mind in the thought process of choosing index options. So the main reasons are ease of settlement to cash, number one, and number two, the fact that in most cases they are European style, and it kind of takes out that element of early assignment risk. So let's do this. Let's go back here to the monitor tab while we're here, right? And let's kind of take a look here. Now, Harry asks a great question. Is there any way to check and see if the security is cash settled? Right. So indexes, if you're trading an index, it's going to be cash settled instrument, right? If it's an index that has options, those are going to be cash settled options. There are watch lists for the indexes that are available. There are also watch lists that are specific to European style versus American style indexes. So you can get that information right here on the Thinkorswim platform. But to high speed, low drags question, when trading these instruments, is volume going to be something that we want to pay attention to? And I'm glad you asked that, because that's going to be part of our discussion today as we look at this. What I wanted to do is I wanted to come back to the strategy that we've been talking about for a while. And that is this strategy that we've been employing as an illustrative example of selling a spread, a vertical spread, 14 days to go until expiration, and then buying it back at 7 days to go until expiration, come what may. And I say come what may in that we've taken some losses, especially when markets have moved pretty big. We've taken some significant losses. we've also seen some pretty big winners in this particular case. In this particular case, yeah, I can work on doing that. The question is, I've got to double check and make sure that I can in fact share P&L information to see how that has played itself out, Chris. So let me work on that, and we'll see if we can do that for next week in terms of that P&L. All right, so let's take a look though. Here's where our strategy is, right? So we sold this put spread, and this was a short put vertical, bullish bias, right? Bias is still bullish in this particular case. We sold the 57.40. We bought the 57.20 put spread, $20 wide vertical spread. We sold it for $2.40. Right now, we could buy back for about $2. It's kind of been bouncing around all morning as the market has been relatively neutral. So we're up just a little bit on this trade, not a lot. We can buy it back for less than we were paid for it to begin with, which is the goal in this particular case. And come what may, in this methodology, just simply says, this is what we're going to do, is we're going to take this trade off. But the reason for this trade, and I want to, again, talk through this, is primarily time decay, theta exposure, right? And so when we think about an at-the-money strike, right, normally we're used to seeing this type of time decay curve, and you've probably seen this before. This is expiration out here, right? I'm just going to reiterate this. If that's expiration out there, time decay looks like this. It becomes more accelerated as we get closer to expiration. That's that rate of time decay that increases as we get close to expiration. That's for the at-the-money strike. We sold this, and it's kind of moved, but we sold this at the out-of-the-money strike. I mean, these were, one standard deviation out of the money. This was like the 17-cent delta. And so what happens to that time decay curve is it ends up looking something like this. The out-of-the-money time decay curve looks something like this, where the vast majority of and the greatest acceleration of time decay comes in this time frame right here. So if this is 14 days to go until expiration, and this is 7 days to go until expiration, we're capturing, by selling 14 days out and buying it back at 7 days out, we're avoiding this time period in a vertical spread where it just kind of sits and cooks slowly and doesn't really eat away much of that extrinsic value very fast, especially as we get close to expiration. As this approaches the zero bound towards expiration, the range and that rate of time decay slows down perceptibly. But by selling it here at 14 days and then buying it back at about 7 days, we're capturing the significant amount of that time decay, theoretically. That's the theory behind this strategy, is that we're capturing rapid time decay at the outset of the trade, as opposed to, trying to hold on to it and being patient. Now, we could be patient because these don't have that risk of early assignment. So we have the luxury of being patient, but we're not going to do that. We're going to take that opportunity to buy it back and redeploy at 14 days out so that we can get that accelerated time decay again. So I hope that's helpful in going through this particular strategy, right? Okay, so let's pop into this discussion and let's see where we are right now. So we're at $2.40 we sold it for. We could buy it back for about $2. We'll see if we can work that a little bit. And I'm going to create a closing order. So we're going to buy this one back. Now I could do this as a roll. I don't typically do it as a roll because I want to talk through the reasons why we're putting on the second trade and where we're going to put on that particular trade. Okay. So I'm going to look at selling this for about a $2 debit. So it's going to cost us about $2 to buy this back and eliminate this trade. And we'll see if we can get that. So I'm going to click on confirm and send. We're going to fire this order off, making sure that I'm aware of the transaction costs and everything else. So we got it for $2. We bought it back for $2. We netted in this particular case about 40 cents. Not a huge return, but on the other hand, not a really huge risk either. in this particular case. High probability trade, but a high probability trade has a low return generally, right? Generally, right? So Healthy You says, well, wait, we could do 45 days and 25 days. Sure, you could. Absolutely. You absolutely could. There's absolutely nothing wrong with that, as long as you have a dispersion between the rate of time decay that you're looking at. That's fine. But you're also in that trade for a longer period of time, right? And if that's the perspective that you want to take, sure, there's absolutely nothing wrong with that either, right? In that particular case. So let's see what we can do now with this particular trade, as this is sitting here, kind of sitting still at the moment. So we're going to go to our index options grid. By the way, this grid I have shared before. It is in the description for this webcast, and you will see this grid there. And this grid is simply left-hand side 1 year, 1 day chart, right-hand side 3 month, 1 day chart. MACD, implied volatility. We can see that implied volatility is low. We looked at the VIX. It's just kind of sitting there. The market is just kind of sitting there as well. This is the 200 period moving average, that blue line. And the trade is, we put this example together specifically for capturing that time decay, is we sell put spreads when the index is above its 200 period moving average, and we sell call spreads when the index is below its 200 period moving average. So right now, the index is above the 200 period moving average, so we're still selling put spreads. Now, this is what we did last time. That's where we sold it, and we can see that the market hasn't really done a lot. So I'm going to take that time hack off, and I'm going to take this is the probability of expiring cone, which shows us a 1 standard deviation range, top and bottom. So 1 standard deviation up, 1 standard deviation down for a specific date. I'm going to go out and I'm going to look and see where my next 14-day expiration is, which in this case is the 11th of June. So I'm going to go back to my chart, and I'm going to put my time hack, which is just this vertical line, and I'm going to go to the, what did we say, the 11th of June? Yeah, the 11th of June. That's right there. So there's my time hack, right? 11th of June. Let me just confirm that. 14 days out. Yep. 11th of June. So what I'm going to say is, remember, we're selling put spreads. So where do I sell that put spread? I'm going to sell that put spread right around the 5,700 strike. Whoops. I don't want a vertical line there. I want a horizontal hack right there at 5,700. That's where I'm selling that put spread. Now, 1 standard deviation to the upside would be up here. And we, in fact, even did an iron condor based on that idea of 1 standard deviation. Could you sell the call spread and the put spread as well? And the answer is, yeah, absolutely. Right? Now, Mighty Mouse says, well, why wouldn't we just consider keeping the June spread? Because it's done the majority of the work that it can do for us. The time decay has really done what we've expected it to do, right? And we can redeploy that risk elsewhere to a point where we're still capitalizing on time decay. That's the reason why, Mighty Mouse. We could keep it. There's nothing wrong with keeping it to the June 6th time frame, but we're gonna kind of keep this through that process and keep that 14-7 idea going, capitalizing on rapid time decay in that first week of this short-term trade. Okay? All right. So let's take a look at this scenario here. Now we're looking at selling at the 5,700. So we're going to go to the trade tab. We're going to go out to the June 11th, which is 14 days to go until expiration. And we're going to go to the 5,700 put. So I've got to go down a few more strikes here. I'm going to add about 75 strikes. Let's see if we get to the, I don't. I got to add more, 100 strikes. There we go. Now I can get to the 5,700 strike price. And you notice if we were to put, and that's got a fair amount of open interest and volume, so it's pretty liquid. I'm not worried about liquidity. I can see that it's got about a 20-cent bid-ask spread, I'm going to look at delta, theta, and vega here. And at our 57 strike, that's kind of where we've been falling, is right about the 17-cent delta. So we're going to look at selling the 5,700 and buying the 5680, 20 points wide. We don't have to go 20 points wide. That's just kind of been where we've been with these spreads, because oftentimes when we get that far out of the money, there is a lack of some of these intermediate strikes. They may have $10 wide increments. So we're going to go to a $10 wide, or excuse me, a $20 wide spread, 5,700, 5,680, and we're going to create that for $2.35. So these are home runs. We're not trying to hit home runs, right? We're trying to capture time decay in a week's time and see how that can benefit us on an ongoing basis. So we're going to look at selling this spread, 5,700, 5,680. It's at the 17-cent delta, which says that it's got a fairly low probability of ending up in the money at expiration. In fact, the index would have to make a big move in this particular case down to get to that point. But if it made a big move to the downside, there's going to be something that might kind of give us a little bit of a kicker here. And that would be the fact that we've got a long 5680 put. So if implied volatility started to rise, that's going to make that 5680 put more expensive. There might be the possibility. We're not going to manage it this way. We're not going to manage this at all. In fact, we're going to simply take this trade off at 7 days. But ideally, what's going to happen is this is just going to see that time decay happen. All right. And the time decay is going to happen to a greater degree in the 5,700 put than it's going to happen in the 5,680, because we want to be able to buy this back as cheaply as possible. So let's go ahead and let's click on confirm and send here in this case. And we're going to read through this order, make sure that that's what we want to do. Max theoretical gain, although we probably will not get to that in terms of this trade because we're going to take it off early. It's $2.35 times 100 shares, $235. Max loss, if both of these legs were to end up in the money at expiration and we were to hold it to expiration, max loss in this particular case is going to be $1,765, right? That's the $20 wide spread minus the $2.35 times 100 shares that we're bringing in for the trade. And we're going to go ahead and we're going to put this in our index options weekly group. And we're going to go ahead and fire this order off. We sold it for $240, exactly what we sold it for last week, right? So here we are. Once again, we harvested, in this particular case, a little bit of time decay. Now, Chris, you're absolutely right. Other than price volatility, is there any reason why this 14-7 strategy wouldn't work with any other optionable instrument? There's not a reason that it couldn't work with other instruments. However, because these index options are very liquid products, if we go back again, we go back to that trade tab, and here we are. I mean, look at where we are, right? The index is trading at 59.07. You saw how many strike prices I had to add to get to the 17 delta, to get to that one standard deviation. You go out one standard deviation on most equity instruments, and there is this decided lack of liquidity at those levels, right? So that's exactly kind of the thought process here in this scenario. Is the reason we do it in an index is because there's liquidity far enough out that it allows us to capitalize on that time decay. Now, Joe asked the question, well, why not an iron condor? In fact, we did that last week. We put on an iron condor. So let's go to the monitor tab. And I'm trying to preserve the sanctity of this particular trade, this strategy, as long as I can before we start riffing on that and doing variations. This was kind of a little bit of a riff off of this idea because we sold almost the same put spread, the 57.40 and the 57.20, and then we sold the call spread at the 61.75, 61.50. We sold it for $4.30. Now here we are, 7 days to go until expiration, and we got about double the time decay, right? Because we were getting the time decay on the call side spread, and we were getting the time decay on the put side spread, and we could close this iron condor down here at 7 days to go until expiration, and we've picked up just about $2 worth of time decay. So that's exactly kind of the thought process, right? So Joe, talking about making this into an iron condor. Well, that's kind of what we did here in this little riff on the trade. If we were to close this trade down as a whole, create a closing order down, we could buy it back for about $2.40 theoretically. We sold it originally for $4.30. So we're going to harvest a little bit of that. We could close one side down. We could close that call side down, because that call side down has gotten really cheap. We could buy that back and eliminate that obligation and then walk it down the road a little bit. We could buy back the vertical side, the put vertical side, which has retained a little bit of its value here in this particular case. So we could buy that one back for $2.10, or we could buy the whole vertical spread back for $2. And what do we say? About $2.40, right? And eliminate that obligation. We could choose to do it again if we wanted to. So let's do that. Let's go ahead and buy this back just in the interest of kind of closing the loop here a little bit. I'm going to see if we can work this a little bit, maybe down to the 220 mark or so. We'll click on confirm and send. See if we can work this order a little bit. I'm going to look at closing. This is to close the trade down. And remember, anytime you've got 4 legs, there may be some challenges in terms of closing down a trade. But again, that's where liquidity matters. And we'll see if we can close that one down. We might have to work that a little bit. But yeah, Ricebird, a little bit of, collecting that particular income in this particular case. All right. So now I want to go back to Truth's question here, which is, well, wait a second. What about a calendar to try to take advantage of that same scenario? So a vertical spread exists in the same time frame, in the same expiration, and in at the same or at different strike prices. But what if we were to do something to take advantage of kind of the disparity time-wise between a short-term option and a long-term option? Okay. Wow. Okay. So let's take a look. And again, let's go back to our grid here. And I'm going to zoom in on this right-hand side just a little bit more. We've kind of got that neutral movement, and we've got low implied volatility. It's just kind of sitting here. So when I see neutral movement and low implied volatility, my strategy thought begins to consider something like a calendar spread. What trade works well with low volatility, low or neutral movement, and not a lot of movement expectation? And that would be a calendar spread, because a calendar spread works by taking advantage of the differential, the dispersion between implied volatility and time value between a closer dated option and a longer dated option. Okay. And it takes advantage exactly of this type of scenario. Now, the thing about it is, a calendar and a diagonal does as well, right? And I'll show you how we can kind of create this as a diagonal as well. But if we were going to choose a calendar spread, one of the things that we might do is we might look at the possibility that if this does start to move maybe to the downside, that implied volatility rises a little bit. Okay. So if implied volatility goes up, how could we put that to use in our favor? So neutral movement, rising implied volatility. So what I'm going to choose in this particular case is a long put calendar spread. And let me show you what I'm thinking of here in this particular strategy. So low implied volatility, neutral movement, but with a little bit of a possibility of downside move. Let's say, for instance, NVIDIA's earnings come out and they don't meet expectations, because when does that ever happen, right? So what if we see a little bit of downside movement? So what I'm going to do is I'm going to go to the trade tab and I'm going to say, hey, what if this moves down towards, say, for instance, this 5,900 mark? It's at 5,904, or maybe at 5,975, somewhere where we've got another resistance, or maybe at 58.50 or so. So let's go to the trade tab. And the other thing that I happen to notice here is that I've got a disparity in terms of implied volatility. So remember we talked a little bit about 0 DTE trades and we talked about 1 DTE trades. We've done a couple of those. A couple of weeks ago, we did a 0 DTE trade. I think last week we did a 1 DTE trade. So today I'm going to do a 2 DTE trade just to kind of keep it consistent and going. But think about this. In a 0 or a 1 DTE trade, specifically in a 0 DTE trade, one of the challenges is our risk desk at the brokerage, as Charles Schwab, the brokerage, is uniquely focused on the idea of protecting positions that might realize adverse movement. So if there is the potential for higher volatility, especially in a high volatility environment, although VIX is relatively low at the moment, there's the possibility that a trade would not be initiated or would be rejected or would be closed if there was that possibility of or the likelihood of it creating an adverse movement situation. So it might be challenging to put on a 0 DTE trade. That is one of the challenges of that particular strategy. So we looked at going to a 1 DTE trade and knowing that a 1 DTE trade is going to turn into a 0 DTE trade the next day. All that time decay is going to go away. Now we're going to look at a 2 DTE trade. And I'll show you what my thought process is in this particular case. So my thought is, because in this 2 DTE time frame, which is Friday, the May 30th, look at the implied volatility that is built into those 2 DTE options. Almost 23% implied volatility. And then if we go out to, say, for instance, the 9 days to go until expiration, there's our 6th June expiration. That's got, actually, you know what, let's even go 2 to 8. Let's go 2 to 8. So let's go to 5 June, because that's got a little bit less implied volatility, 17%. So we can capitalize on this dispersion between those 2 levels of implied volatility. What that means is there's more premium in these 2 DTE options than there is in the 8 DTE options. So we're going to capitalize on that, hopefully, because we want those to decay away. Now, we're going to be selling close to the at the money. So you remember, what did we say about the at the money time decay curve? That at the money time decay curve looks like this. So we want that to accelerate. So we sell right here. We sell 2 days to go until expiration. What's happening to time decay? Oh man, we are collecting a whole lot of time decay. It's working for us. Theoretically, if this does what it's supposed to do, that's the most rapid amount of time decay in this scenario. So we're putting that to use in our favor. So let's create this trade. So we're going to go to the, whoops, let me grab my, there is my icon. We're going to go to the 2 DTE. I don't need 100 strikes. I'm going to bring this down to 14. And I'm going to say, look, I want to sell in this particular case. We said let's go to the 58.95. We're going to give it a little bit of room to move to the downside. We think it might move down to the downside. Look at the rate of time decay in this 2 days to go until expiration. It's losing $10 a day. Wow. And implied volatility impact kind of backs off a little bit. But we're going to sell that 58.95. And then we're going to go back to the 8 days to go until expiration, the 5 June, and we're going to buy the 58.95. Look at the rate of time decay on that one. We don't want that one to decay away. We want our short one to decay away very fast. And if implied volatility goes up, that's going to help this one. So look at the difference. I mean, there's almost $7 of difference in the rate of time decay between these 2 options. So if I'm going to now buy this one, the 58.95, I'm buying and selling the same strike price, right? Just in different expirations. I'm buying it for $17.20. So it's going to be, because this is a bigger index, this is going to be expensive. But guess what? That's our max theoretical loss in the trade. If we click on confirm and send, that's our max loss in the trade, right? Now, what do we need to know? Well, we need to know that this is a relatively low probability trade, because if we right click and we analyze this trade, And we just do this. Let's do hide positions. And let's bring this risk profile graph here to our calendar spread and kind of slide this over a little bit so that you can see it. Here's our area of loss, either side, up or down. Here's our max theoretical gain if at expiration. We're not going to necessarily hold this all the way till expiration, but if at expiration the price of the index is at 58.95, we would get that theoretical maximum gain. But that's a very narrow target to try to paint, right? So what we're going to do is we're going to try to take this off if it's done about 50% of the max theoretical gain. So there's an easy way to do this, and I know we've talked about this a couple of times in terms of putting this trade on, but a max theoretical gain, because we can't calculate it because it doesn't take into account rolls. Because if you do this, if you right-click and do confirm and send, you notice that it doesn't create a max profit or a max theoretical loss. We know what our max theoretical loss is in the trade. It is what we're paying for the trade. How do we calculate that max gain? Well, we could put our cursor right here and we could say, oh, that's our max theoretical gain. Kind of a shorthand rule of thumb that we might think about would be this. Take your net debit, what the cost of the trade is. So I'm just going to do 1720, and I'm going to times that by 2. So a really good outcome in this trade would be doubling what we paid for it. We're probably not going to see that. That's probably theoretically very, very unlikely. So what if we do this? What if we say, okay, the difference between these two, what if we were to get half of that particular gain? So the way that we do that is 1720 divided by 2 is $8.60. So now we say $17.20 plus $8 and what did we say, 60 cents? So if we could we could sell this vertical spread, or excuse me, if we could sell this calendar spread for $25 or more, we've now made about 50% of that max theoretical gain in the trade. So all I did in this particular case is in putting this particular trade together, in creating this vertical spread, is getting to that where I'm willing to take the trade off, right? So, Bob, that's not been my experience. Calendar spreads? All right, so that's an easy way to calculate what that potential target might be. So let's do this. What I'm going to do is I'm going to bring this order up, and now what I'm going to do is I'm going to create this as not a single order, but a first trigger sequential. And I'm going to right-click, and I'm going to create an opposite order. So I'm going to put in an order that's going to be a good till canceled order, and I'm going to take this trade off if I can sell it for $25 or, whoops, let's see if I can get to that. $25 or more, and we'll make that good till canceled. So I'm paying $17 for it. If I can take it off for $25, great. I've captured the majority of the trades that the gain that I can make in the trade. Bob, that's interesting. Maybe get in touch with the trade desk regarding that, because my experience has not been the same. Just saying. Click on confirm and send, read through this order, and we're going to put this in our index options group. Here's our calendar spread. And again, you can see that the buying power impact is going to be large because this is a large index, right? But we're now putting this trade on, and we're putting on an order to take it off if it does what we expect it to do. And we'll see if we can put that trade down. And yeah, that's 38% return on investment. So we're in the trade now. We're going to follow that trade and see how that works. All right. Now, you could use, and I want to answer this particular question. I know we've just got a second or two left in this particular case. So if we were to go to the trade tab and we were to go to XSP, which is also a European style index, it is the 1/10 the size of the SPX. But let's change our volume and open interest. And if we were to go to that 2 days to go until expiration, and we were looking at selling the 589, you can see that the open interest and volume is quite a bit smaller. So liquidity matters, right? This may be a little bit harder. You may give up a little bit more in slippage in terms of entering and exiting the trade, right? So there you go. So that becomes the smaller alternative. Let's just do the same thing really quick here in XSP just to see that works. So we're going to sell that one, and we're going to come back to our 5 June, and we're going to buy this one. And you can see the size difference. This is $1.74 net debit versus $17.40 net debit on the larger trade. Much smaller buying power impact. We'll put this one in our index options group and click on send, and we'll fire that one order off, and we'll see if that works for us as well. And I probably did buy and buy in that one, so we'll see how that trade works. Nope, I did sell and buy. Okay, very good. All right, so resources, guys, really quickly. Come on over here to Trader Talks webcast, the Trader Talks webcast page. We've got a new feature here. If you click on posts in that link, you can see our daily calendar with the lineup of our typical webcast. Now, this may change because of substitutes and those types of things, but you can see that typical lineup. You can see all of those bright, shining faces right there of our team, and you can see what they teach on a regular basis. So we would love to have you join us for this. Again, remember to click on subscribe and like. And again, remember to leave some comments in the comment section if you're watching the recorded version. My thanks to Cameron May for helping out. We will see you guys again here next Wednesday for more discussion of index options. Have a great week, everybody. We'll see you then. Take care. Bye-bye.